The tape is running a shade thin this morning, a clear sign of institutional hesitation before the next major data print. We are standing at a crossroads, managing the residual tremors of recent employment data against the persistent hum of inflation expectations. Let's look at the indices, shall we? The S&P 500, represented by SPY, sits stubbornly flat at $690.31, down just a hair by -0.01%. The tech-heavy QQQ mirrors this stagnation, also flatlining at $623.89, -0.01%. This parity suggests a market holding its breath, waiting for a catalyst. However, the message is not uniform. The small caps, the barometer of immediate risk appetite, are showing cracks. The IWM is lagging significantly, down -0.51% to $251.42. This divergence, S&P flat, small caps shrinking, is a structural weakness that institutions are noting intently. When risk on liquidity dries up, it hits the smaller end of the spectrum first. Meanwhile, volatility is creeping back into the system. The VIX, our fear gauge, has jumped over 8% to 14.82. This is not panic, but it is certainly elevated anxiety. The narrative is shifting from Goldilocks to Goldilocks on thin ice. We are watching these spreads closely. The narrative architects of our global economy are speaking, and their words carry weight, even when delivered with political nuance or strategic ambiguity. We heard from President Trump, described as a very aesthetic person by himself, positioning construction as his secondary craft. While personal branding is his domain, market infrastructure remains tethered to policy, not aesthetics. Across the pond, ECB President Christine Lagarde reaffirmed the substantial gains of Eurozone integration. This underpins the institutional commitment to the shared currency bloc, even as monetary policy diverges slightly from the Fed. But the real focus remains on the Fed's stewardship. 6 potent words from Chair Powell are being dissected, words that, according to the Globe and Mail, are likely to haunt Wall Street post-2026. Powell is navigating a tightrope between labor market cooling and inflation targets, a legacy decision now being priced in by futures markets betting on year-end rate cuts. The titans of capital are positioning for this pivot. Jamie Dimon detailed his 11 big trades of 2025, featuring everything from bubbles to a spectacular 367% jump in one position. Dimon sees movement where consensus sees stasis. Conversely, we have contrarians sharpening their knives. Michael Burry is explicitly betting he is not too early in going against the AI juggernaut. This flies in the face of the incredible conviction displayed by Jensen Huang, who describes programming AI models as akin to programming a person, a fundamentally transformative process. And on the subject of conviction, Michael Saylor, after his early pivot away from Bitcoin, seems to have returned to the fold, posting a cryptic "back to orange." This move from a key institutional crypto advocate offers a flaw beneath the recent weakness we observe in digital assets. The bond market is where the true story of future expectations is written, and right now, the ink is running thin. We are seeing a clear signal. Markets are pricing in aggressive monetary easing later in the cycle, driven by cooling inflation expectations and weak labor prints. The consensus is now firmly leaning toward rate cuts before the end of the year, despite Fed messaging often attempting to push back against this further. What confirms this? Look at the European data. The ECB is being eyed closely, but the UK narrative, as highlighted by This Is Money, is suggesting that significant rate reductions might not arrive until 2026. This divergence, the US pricing in cuts now versus the UK delaying easing, is exactly what is driving the FX dynamics we see. When inflation expectations moderate, and our CPI survey suggests a milder 2.2% target for next year, the duration premium demanded by investors shrinks. This supports the long end of the curve, pulling down yields, which in turn boosts the equity valuations of long-duration assets, like growth tech. The Treasury market is essentially agreeing with the late-cycle doves. The economic deceleration narrative is outweighing any immediate inflationary scare. Watch the 10-year yield carefully. It is the key anchor for risk asset pricing. We have fresh data points impacting the immediate outlook for monetary policy, and they paint a picture of deceleration. The U.S. labor market just released figures showing only 73,000 jobs added in July, coupled with significant downward revisions to the preceding months. This is not a strong, tight labor market. This is a market rapidly shedding momentum. When hiring slows this much, the Fed's mandate to maintain employment is tested, giving them cover to cut rates sooner rather than later. Simultaneously, the U.S. inflation CPI survey suggests expectations settling around 2.2%. This is squarely within the Fed's comfort zone. Therefore, the combination of cooling labor and moderating inflation expectations creates a potent environment for interest rate cuts. Contrast this with the ECB. While Lagarde is positive, the economic reality across the continent is uneven. The FX market is reacting to this divergence, with EUR/USD equals X trading at 1.18, down -0.14%. The dollar maintains its underlying strength, perhaps reflecting global flight to safety amidst growth worries, or simply the market pricing US policy as less uncertain than its peers. Commodities are telling a story of conflicting demands. Industrial metals are surging on supply constraints, while energy remains subdued, reflecting muted immediate global growth forecasts. Copper, the essential bellwether of industrial health, saw Freeport-McMoRan, FCX, jump 8% on a fresh high for the metal. This is a supply-side phenomenon, perhaps driven by geopolitical risk or reduced output, rather than an overwhelming demand surge reflected across the broader economic indices. Natural gas is also showing bullish signs, with Venture Global, VG, jumping 9.4% on perceived demand increases, potentially related to seasonal factors or storage concerns. Gold remains anchored, but our attention is drawn to the speculative narrative. There is a claim circulating that XRP could outperform both gold and silver. This is noise, but it highlights the ongoing competition for safe haven capital in the digital asset space. Oil prices, which we track closely, are relatively stable, reflecting the overall market equilibrium where slowing growth expectations offset supply discipline from producers. The intra-market leadership rotation is pronounced today. The outperformer, technology, remains the primary engine of upside, but not universally. Nvidia, NVDA, continues to defy gravity, climbing plus 1.02% to $190.53. Jensen Huang's vision, as discussed, is translating directly into pricing power. AI remains the singular growth narrative strong enough to ignore macro weakness. The laggards, the major casualties, are concentrated in high beta consumer and risk-sensitive areas. Tesla, TSLA, is down a significant -2.10% to $475.19. This suggests investors are rotating out of discretionary and speculative EV names in favor of established, AI-driven infrastructure. Apple, AAPL, is slightly lower, and Microsoft, MSFT, is flat, indicating tech leadership is becoming highly concentrated in the picks and shovels providers of AI. In the broader market, look at the M&A activity driving specific gains. Clearwater, CWAN, soared 8% on a massive $8.4 billion merger. Sector consolidation is strong where the underlying fundamentals, like water infrastructure, are non-cyclical. We also see the departure of Warren Buffett casting a shadow of uncertainty over Berkshire Hathaway's succession planning, according to The Economist. This is an institutional event. The transition of capital management requires clarity, and ambiguity pressures valuation. Bitcoin is exhibiting classic risk-off behavior against the backdrop of broader market uncertainty, albeit mild. BTC/USD is down -0.25% to $87,620.44. It is failing to hold key psychological levels when equities wobble. Ethereum, ETHUSD, is the slight outlier, up plus 0.42% to $2,960.86. This minor outperformance suggests that capital flowing into digital assets is favoring utility platforms over the primary store of value narrative right now, likely due to development progress or staking yield attractiveness. The sentiment around Bitcoin is bifurcated. While Michael Saylor signals a return to the asset, Nouriel Roubini's past dire predictions about Bitcoin's days being numbered serve as a useful counterpoint to the maximalists. For us, the institutional view remains clear. Digital assets are speculative beta exposure, and they will trade with the VIX until proven otherwise. The 24-hour change shows they haven't been proven otherwise yet. The market is currently priced for deceleration and eventual Fed easing. The key risk today is a data print that suggests inflation is re-accelerating despite the weak jobs report, a stagflationary anomaly. If the CPI survey of 2.2% proves wildly optimistic, the rate cut bets will unwind rapidly, hitting high growth, high duration assets hardest, putting immense pressure on the QQQ and NVDA. Conversely, any data suggesting further labor market deterioration will solidify the rate cut thesis, likely seeing a relief rally in SPY, though the IWM may remain sluggish due to funding availability concerns. We are in a period where macro narratives, labor, inflation, rates, are battling the micro narrative of technological transformation, AI. The market's current narrow focus on NVDA shows that technology is winning, but this narrowness increases systemic fragility. Today, we are witnessing the careful calibration between expected economic slowdown and aggressive monetary accommodation. The indices are paralyzed, but internal market leadership is narrowing dangerously. Institutions are not fleeing, they are repositioning. They are rotating towards scarcity, be it in copper supply or proprietary AI infrastructure, and away from broad, cyclical risks implied by the underperformance of the IWM. Our directive remains: maintain portfolio duration discipline. Wait for confirmation on the inflation trajectory before making large directional bets. The VIX is elevated, signaling caution.